What is going on, traders? So there is an interesting scenario in which the market can actually melt up back to all-time highs very soon. And I will definitely get into it in this video. And I'll show you what indicators that I'm eyeing like a hawk and that I think you should be too if you care about your portfolios. The volatility index remains above 20. We have rising interest rates this year. So there is no secret that the market is on pins and needles waiting for the next big move by the Fed. Now, the next Fed meeting is going to be March 15th and 16th. So what happens from now until then? And what stocks tend to do well in high interest rate environments? We'll go over what that looks like historically and what that looked like in 2016 when the first time that rates were raised after the 2008 financial crisis. I'll also be showing you some of our stock picks and how I'm hedging considering the volatility that we still have sticking around. Everything will be timestamped below, so feel free to forward and reverse as you like. So let's get right into it. The first thing that I'm looking at is the 10-year treasury note. Now, why am I looking at this? Well, this is basically the benchmark that determines what interest rates look like for the entire economy. Mortgage rates are based off of the 10-year, etc. There's this myth that there is a direct inverse correlation between the yields and stock prices, meaning that when yields rise, stock prices tank. Now, if you look back historically, it's actually a very mixed bag. There are times when they are directly correlated. There are times when they are directly inversely correlated. But this to me looks very close to a situation that we saw back in March 2021. For all of you newbies who entered the market in 2020 or 2021, you'll remember that in March, that's when everybody thought that we had a correction coming. And we did in the NASDAQ. We did not in the S&P 500, but the NASDAQ saw almost a 12% drop in March 2021. And we are now down about 12.5% as of the time of this recording. And if you look at the 10-year treasury note yield, and you can look this up in TradingView by typing in the ticker symbol TNX. But if you look at the 10-year treasury yield, it hit a swing high back then. So it was like around 1.7.5. And this occurred while the NASDAQ already saw a correction because of the rising interest rates. However, when that treasury note yield hit a peak at 1.7.5, the NASDAQ started climbing again. So currently, like I said, the NASDAQ is down 12.5%. And the 10-year treasury note is very close to 2%, which is a major psychological level. This is the highest that it's been in 2.5 years. Now, here is the big if scenario. If 2% is the cap for the short term until the next Fed meeting, and we start to see the 10-year treasury note trade sideways or even decline a bit, then there is a very high probability that you will see the market get back to all-time highs. Now, there's a big caveat here with CPI, the Consumer Price Index. That will be released on Thursday, February 10th, and that will tell us how bad inflation is. If we see inflation at an 8% rate, remember it was 7 last time. So if it's way above expectations, then you can expect Papa Jerome Powell to come in and shake things up. And we will likely see a very fast 50 basis point raise on the Federal Reserve interest rate. And here's what is very interesting. If you just look at the first week of February, there is a tracker here that shows you what the probability of a rate hike is and to what extent the rate hike will take place. And this is based on the Federal Reserve members and basically the expectations that they submit to the Federal Reserve. The first week of February, which is just a week ago as of the time of this recording, a 50 to 75 basis point rate hike was targeted at a 6.6% probability. Just a week later, now we are looking at a almost 29% probability that we will see a 50 to 75 basis point rate hike during or at the March 16th Fed meeting. Now, I've talked about this in previous videos before, but if you look at the volatility index, which is basically the fear gauge that the market uses based on the activity that we see in S&P 500 options. In 2022, we have barely been under 20. And usually, as of late, a measure under 20 shows that there is relative stability in the market, which is why in 2021, when we had a massive bull run in the mega cap stocks, most of the time, the VIX was under 20. But clearly, the market is holding its breath for that March 16th meeting and the CPI numbers that are going to be released on February 10th. I know that this is a lot to take in, so let's just recap real quick. Number one, look at the 10-year treasury note. See if we can cap out at 2% and not go any higher. If we start to trail off from there, then you can expect a potential bull run in the market back to all-time highs, at least until that March 16th meeting. Number two, look at the VIX. If we can get the VIX under 20, then that will show that the market actually now remains calm. But I don't think that will happen until the CPI data is released. So look at the CPI data as well. If we can come in line with expectations, that is the neutral scenario. If we can come in better than expectations, meaning lower than what the economists expect, that is a good sign than what Jerome Powell said about expecting inflation to trail off. That's a good sign that that is likely to be a reality for 2022. And real quick, if you get anything out of this video, please leave a big fat thumbs up just like this and allow others to find this video because I think the information is useful. Now, in terms of the trades, let us get into the trades, how I'm trading this and what stocks tend to do well in high interest rate environments. As I've been repeating on this channel for months now, I'm not really holding long positions without a hedge. And I've been hedging against the NASDAQ and the S&P 500 mostly because those are the stocks that I own. So right now I have a hedge using what is called a credit call spread or a vertical call spread. You can obviously just buy outright puts if you are not authorized to trade spreads yet, or you have not delved into that world yet. And by the way, if you want to learn how to hedge with options, which is a great way to make sure that your portfolio doesn't bleed while the market is downturning, then sign up. Link is in the description below. It is a great value. Come join a group of over 4,000 traders. We're also running a flash sale on the options course, depending on what time you catch this video. And that link is also in the description below. You get $200 off if you happen to catch the discount in time. Now, we also put out alerts for a few mega caps that people have been waiting to buy the dip on. As I said, if you're buying for the long term, you should not be concerned whether this is the absolute bottom or not. So when Amazon was trading at 2,700, we bought Amazon, currently trading at 3,228. Same thing with Microsoft when it fell to 273 after hours on an earnings overreaction. Same thing, by the way, with the SPY, which hit the 300-day moving average, because I've showed this before. But generally, buying the S&P 500 correction has panned out and has returned a 15% rate over the next 12 months on average. That is the median return every time the S&P drops by 10% or more and you end up buying it. Same thing with the NASDAQ. Historically, buying NASDAQ corrections are very favorable to your portfolios. You could see here, you can screenshot this and look at the stats for yourself. But basically, most of the time, you will be profitable within 1 month after the NASDAQ corrects, almost certainly after 3 months, and even more certainly after a year. So buying an ETF like the SPY, which tracks the S&P 500, or an ETF like the Triple Qs, which tracks the NASDAQ, to me, I'm not concerned whether this is a low or not. If you look at any point in history, buying at a major moving average like the 300-day moving average has been lucrative each and every single time. If you are long-term, these are not short-term trades. Also setting up an options day trade watch list, which is neutral every morning. This allows me to basically play either the bullish side or the bearish side, depending on what is going on with the chart. I have a whole video detailing how I do this. I will link it here. And in terms of what stocks do well during high interest rate environments, it's probably not a surprise, but traditionally financial stocks have benefited the most from rising interest rates because that's when they make the most money. The cost of borrowing money goes up. So with that said, that is why we actually bought XLF when it dipped. And if you look at XLF right now, it is near all-time highs. We alerted XLF when it was back at the 200-day moving average, and this is expected to continue up into new high territories. XLE, which is the energy sector as well, this is also pushing to highs, but not all-time highs. We are looking at 2 to 3 year highs here. Now, XLE is one that I would actually buy on weakness. I wouldn't buy it here because it looks like it is overbought. But the next time that it retests the major moving averages, I will look to re-enter XLE. And during an environment where interest rates are rising, which is usually a signal of a healthy economy due to improving employment and the fact that consumers are spending a lot, consumer discretionary stocks can also see a bump during high inflationary, high interest rate environments. Consumer discretionary means things that consumers don't need, not consumer staples like food and shelter, etc., but retail that is basically splurging, right? So travel stocks fall into this category, as well as car manufacturers, retail stocks that have to do with sporting goods like Nike, Foot Locker, etc. You could basically Google consumer discretionary stocks and take a look at those companies, look at their valuations, look at their charts, and pick the ones that are your favorites if you are looking to invest for the long term and you think they are undervalued. And lastly, let's take a look at the last rate hike cycles and see how the market's performed. We've had major rate hike cycles from 94 to 95, 97 to 98, 99 to 2001, 2004 to 2007, and 2008 to 2019. During only one of those rate hike cycles did the market actually perform worse than before the rate hike cycle started. As a matter of fact, the market actually performs worse during rate cut cycles. As you can see here, we've had 2 out of the last 6 rate cut cycles have been down markets. And that is because when the rates go up, or when the Fed is forced to raise rates, it's because the economy is usually doing good. And when the Fed is forced to cut rates, it's usually because of a recession or impending economic factors that are negative. Anyway, traders, that is it for this video. Hopefully you got something out of this. Again, look at the 10-year treasury note, look at the CPI data, make sure you look at the VIX, and also take a look at beaten up quality stocks that you've been looking to buy, where you can start nibbling, and look to also hedge your portfolio in a way that you see fit. If you want to learn how to hedge using options, which in my view is the most effective way, come join our group. Link is in the description below. Would love to have you. Subscribe to the channel. Hit that notification bell. Stay safe out there, traders. Peace.